Alka Anbarasu, who's Associate Managing Director at Moody's Ratings. Alka, thanks so much for taking the time. You've recently put out a note on the banking system in India. You've maintained your stable outlook, but you've also noted the potential for improved profitability, solid profitability and growth as well. Take us through what has changed, if anything, between the second quarter and the third quarter, and what are you looking at that is positive at this moment?
Sure. I think overall the operating environment in which the Indian banks are operating is supportive of growth. So whether it's loan growth, but also some of the overhang on asset quality that existed because of, say, where the tariff negotiations were going, some of that overhang has also been withdrawn. And to some extent, we do think that on the profitability side, there is upside because of the rate cuts that RBI front-loaded last year, and we think some of that will flow into deposit costs this year. So yeah, these are three things working in perhaps favor of Indian banks. One is the operating environment, macro conditions, second is asset quality, and third is profitability.
Let's talk a little bit about what is leading to that profitability improvement and which pockets you're seeing this play out in. Because that rate cut cycle, as a lot of people have viewed it, has played out. We're likely to see a pretty long pause from this point on. You had a CRR cut and ample liquidity. The RBI also coming through and saying it wants to keep the system relatively flush with liquidity. So what are the factors as you see it that are leading to this improved profitability outlook?
Yeah, so I think first is on the rate cut. You're right. The rate cut have been front loaded, so they have played out. On one hand, the banks passed on the rate cut on the lending book fairly quickly last year as the lending books repriced. But we expect that the bank's deposit base will gradually reprice now because banks incrementally the bank's deposit base is coming from term deposits. And as they reprice, we expect the funding costs of banks will decrease, and that will give them some headroom on the net interest margin front. The second factor on profitability is credit costs. Again, for I think we do expect maybe marginal uptake in credit costs, but overall, in the big scheme of things, credit costs should not disrupt the profitability picture as well. So all in, it's maybe the NIMs which are the providing the tailwinds to the bank in terms of profitability, while credit costs would remain stable, and that's where the profitability improvements will come. We don't expect a big improvement, but a gradual improvement in profitability.
Alka, good morning, Neeraj here. I'm presuming it's good morning for you as well. But the thing that a lot of people are now betting on is that for the last 2 or 3 or 4 years, all forms of banks in India, including PSU banks, have been fairly discretionary in their lending practices. The bad assets have come off. The cycle wasn't quite in their favor in all of 2025, presumably the second half of 2024 as well. Now, if the rate cuts were to cool off, then even the cycle might turn in that favor, and that might actually be very constructive for bank balance sheets, bank earnings, disbursements, what have you. Does all of this play a part for you when you look at how do you assign, for lack of a better word, ratings to the banking system or specific banks?
Yeah, absolutely. Perhaps for the last 2 years or so, we have taken several positive rating actions on Indian banks, whether it's the public sector or private sector banks. Fundamentally, like you mentioned, asset quality has been cleaned up. They are very well capitalized as well. And on the operating environment, perhaps there was an overhang last year from the tariffs, but to some extent, the operating environment is quite supportive despite those tariff fears last year. But going forward, we do expect the operating environment will be quite supportive. So yeah, indeed, all in, it is a favorable operating environment for the banks. Perhaps there are two areas that I would want to highlight, which we are watching out for closely. One is while loan growth could accelerate, and we think getting to mid-teens or so. Having said that, loan growth will be subject to the bank's ability to garner deposits, and we expect deposit competition to intensify further. And obviously, The households have many other avenues for putting their deposits as well. So deposit competition is one unknown factor at the moment. And the other unknown factor is perhaps there are some risk on the margin on asset quality, particularly where household leverage has been increasing, and there are some pockets of weaknesses in certain retail segments.
One more question. If indeed the cost of funds is going to be competitive for most banks, would you believe there to be a pricing war of sorts which may impact net interest margins, despite the fact that the RBI may not cut rates any further?
There would be some amount of competition, particularly for the better rated borrowers, and also perhaps to some extent the NBFC sector, which is doing quite well in the current climate as well. Having said that, there is a growing demand for credit, and increasingly banks are lending to MSME or retail sectors. The competition for bank lending within those sectors is not as high as what it is for the corporates who have perhaps a better pricing power as well. So we do think that as banks increase this MSME lending, they do have the advantage of being the sole lender or being the first mover in some segments where they could hold the pricing as well.
Okay. Alka, we'll leave it at that. Thank you so much for taking the time out and being with us. Really appreciate your time.
Thank you for having me.